Hello and welcome to our first quarter 2019 large cap growth portfolio review. I'm Barry Peters, Managing Director of Client Service at Winslow Capital. Winslow Capital had a very strong quarter in terms of absolute and relative performance. Accommodative central bank policy and increased optimism on trade negotiations drove a strong rebound in global equity markets. U.S. equities led the way. The S&P 500 returned almost 14%. Outpacing the strong returns generated by key risk assets. Growth equities outperformed the S&P 500 and our portfolio added further to these robust results. Today we will highlight our investment process, detail performance and attribution, and underscore our work which continues to point to a positive environment for growth equities. At the risk of sounding repetitive, we model a continuation of the post-2012 to 2016 era when extremely low interest rates and meaningful multiple expansion was a headwind for active management. Since the end of 2016, growth equities have outperformed the market, and over this 9-quarter period, we've ranked in the top decile versus our peers, and the portfolio's alpha generation has been exceptionally strong. Our no preferred habitat approach to growth investing means that we will always have 3 types of growth companies in our portfolio, typically with 25 to 40% in each category. These are consistent growers, dynamic growers, and cyclical growers. Each growth category has a unique risk-return profile, resulting in portfolio diversification and performance consistency across both business regimes and cycles. Our no preferred habitat approach to growth investing is the cornerstone of our process and drives the tenets of our long-term success: diversification, flexibility, and consistency. Turning to the first quarter performance attribution, all sectors in the Russell 1000 Growth Index generated positive absolute results for the quarter. Our stock selection in the healthcare and industrial sectors led relative performance. Strong stock selection in healthcare was particularly notable given the sector was the weakest performer in the Russell 1000 Growth Index during Q1. Also adding to relative performance was our avoidance of the consumer staples and energy sectors, both of which underperformed the broader Russell 1000 Growth Index. Shifting to our outlook, we have several observations. The fourth quarter decline in global equity markets was driven by slowing global growth and fears that policy errors would further undermine the fragile global economy. The mirror image of these factors facilitated the rebound in the first quarter, with the Federal Reserve shifting its stance away from further tightening, followed by central banks in Europe and China providing additional monetary stimulus to their own economies. Global monetary policy is now poised to enhance growth for the remainder of 2019, and we currently see little evidence of a U.S. recession. We also see little evidence of meaningfully rising inflation and anticipate interest rates to remain low. Equity market valuations for value, blend, and growth stocks are modestly above long-term averages. Thus, we anticipate the primary driver for prospective returns will be earnings and cash flow growth. The current environment remains highly dynamic. The fourth industrial revolution will mean technology-driven changes will alter nearly every industry, impacting earnings growth and terminal values. We assess our portfolio positioning for a number of vantage points, including habitat, industry sector, and the weights of specific holdings. First, let's discuss our current positioning by habitat. Given the strong outperformance of both the dynamic and consistent growth categories during the quarter, each represented 41% of the portfolio at quarter end. These levels are at the high end of our typical range, rendering cyclical growth below historical levels. We anticipate future category positioning to move more closely in line with typical ranges given the relative attractiveness of certain holdings in the cyclical growth category and our view that economic activity will improve. On a sector basis versus the Russell 1000 Growth Index, the portfolio remains most overweight the healthcare sector. The sector in aggregate faces some negative sentiment and continued pressure on drug pricing, but despite the more challenged environment, we model compelling opportunities, particularly in medtech and life science tools. Our holdings in both subsectors are benefiting from stable demand and strong product innovation. Our second largest overweight sector is consumer discretionary, The backdrop for the U.S. consumer remains healthy with a strong labor market, wage growth exceeding inflation, and personal tax cuts adding to spending in 2019. Information technology represents the largest absolute sector weight, and we model strong IT spending driven by record profitability levels, new technologies, and the need for every industry to address disruption. Our largest underweight sector remains consumer staples as we model little or no growth for companies in this sector. In summary, we are pleased with our robust absolute and relative performance this quarter. We're also pleased that the markets have been consistent with our expectations of a strong environment for active management. Post-QE, we have had a near ideal environment for fundamental stock pickers, and we believe Winslow Capital is uniquely well positioned given our size, disciplined investment process, and highly experienced investment team. Thank you for listening to our Q1 update. We look forward to visiting with you again next quarter.